Hi everyone, I welcome you all to my another video. Today let's see about what is the difference between an equity instrument and debt instruments. As an investor, we should know what are the different financial assets available for us to invest, and then we have to choose the one which will suit us best. For every business organization, capital is the basic requirement to fulfill their long-term and short-term financial needs. An organization generally raises its capital using two types, that is either through issuing equity or through borrowing debts. Owned capital can be in the form of equity and borrowed capital refers to a company's debts. And equity and debt instruments differ from one another in different ways, that is it differs in risk and it differs in returns. Now let's see what is an equity instrument. Generally equity instrument means shares of a company, that is they raise capital through issuing shares, that is funds raised by a company by issuing shares is known as equity. Equity instruments allow a company to increase, that is to raise money in exchange for a portion of the company without incurring debts. They offer ownership position in the company. Generally, stocks are the basic types of equity instruments, and mainly there are two types of stocks issued, that is common and preference shares, and holder of these shares are called shareholders, and dividends are paid to the holders. Here shareholders get voting rights. Equity instruments have high risk and high return ratio. Because stock market is very volatile, it has high risk, and equity holders will not be given priority in case of bankruptcy or liquidation of that company. And it also gets high returns, that also get high dividends when the company makes much profit, and when the share value increase also they can be benefited well when compared to other debt instruments. Debt instruments are corporate borrowings, that is money raised by a company in the form of borrowed capital is known as debt, and these debt instruments are issued by the companies, a government and private and public company by both. Debt instruments comes under fixed income instruments, that is after the maturity period the capital is returned back. It has a fixed rate of interest, and debt instrument holders are called creditors to the company. They don't have voting rights, but they have a fixed return periodically, and they have no right to dividends also. These debt instruments are little risk when compared to equity investments, because these debt instruments are less volatile than stocks, and during liquidation of the company too, the creditors, that is the debt holders, are paid first. Moreover, debt instruments comes in the form of secured and unsecured debt instruments, so it is more safe when compared to stocks to invest in debt instruments, but it gives lesser returns compared to equity investment. These are the very main difference between an equity and debt instruments, and thank you for watching this video. Kindly subscribe to this channel and share this video.